Hello and welcome to The Insight by Oaktree Capital. We've got a special episode today, live from the Oaktree office in Los Angeles, covering the topic of the liquid private credit convergence. You can also watch the accompanying video to this podcast on the Insights section of the Oaktree public website. Now, over to you, Armen.
Hello, I'm Armen Panossian, co-CEO and head of performing credit at Oaktree. Today, I'm delighted to be joined by my colleagues, Raghav Khanna and Danielle Poli. Raghav is co-portfolio manager in our global private debt platform, and Danielle is assistant portfolio manager in our multi-asset credit platform. Today, we're going to be talking about a critical topic, and that is the convergence of public and private credit markets, as distinctions blur between direct lending on the one hand and broadly syndicated loans on the other. At Oaktree, we've been investing in public and private credit markets for many years and are acutely aware of the evolution of this market opportunity. First, to level set on the context and the history of public and private credit, Raghav, can you open and give us a sense for the history of the private side initially?
Sure. First, maybe to provide some context, it would be helpful to define what is the private credit market. And there are 5 large components to it. The biggest one is direct lending, which is 40 to 50% of the market. Sometimes, confusingly, it is used interchangeably with private credit. It's the biggest piece of private credit, but not the only one. And direct lending is a senior product. So it's first lien or unitranche lending, usually to corporates, mostly owned by private equity sponsors, sometimes owned by non-sponsor actors. Then you have junior debt, which is the same concept, but second liens, mezzanine debt, preferred equity. You have, of course, the distressed debt and opportunistic credit sleeve, which is, of course, more cyclical. And then a big and growing area in the market is asset-backed finance. This is interesting because it is lending not to a corporate or a corporate borrower, unlike the other categories I mentioned. You're lending against a pool of assets such as loans, receivables, equipment, and capital fleets. And most of these assets are self-amortizing. They pay off pretty quickly. So one, you diversify away from corporate risk, but second, their duration is much lower. Then lastly, I would say another area of growth is NAV financing, which is a type of fund level financing where a manager, such as a private equity firm, will go and raise financing against the portfolio of their holdings. There are other areas in private credit. There's, of course, venture lending, there's infra lending, but these are the 5 biggest pieces. And look, the market's grown a lot. Now, what opened the door for private credit, I think we all know, was the post-GFC regulatory changes which forced banks to retrench from the space, especially in the below IG space. But if you look at private credit, the reason it's had staying power is because it's produced a good track record, strong results, low correlation to public markets, and low losses through multiple market cycles. So at this point, it's not a novel category. It's a core allocation for most LPs, and especially the larger and more sophisticated LPs.
So private credit is a very broad term, means a lot of different things: corporate direct lending, asset-backed, opportunistic, and very significant growth. A lot of development in terms of the sub-asset classes and a lot of acceptance on the part of investors as to how it is a permanent allocation in their portfolios. Now, let's compare that a little bit to the public side, specifically to broadly syndicated loans or high yield bonds. It'd be great to understand, Danielle, from your perspective, how has that evolution occurred?
Well, there's a really interesting parallel there between private credit and the growth and evolution in that market and high yield bonds and syndicated loans. Both kind of started as more niche strategies. They've become mainstream. If you think about when Oaktree's founders first started their investment activities in the late 70s, early 80s, high yield bonds were referred to as junk bonds. And that market has developed with thousands of borrowers, large companies, sometimes enterprise values over $1 billion. So these are household names, and it's really become a mainstream part of the liquid credit markets. Broadly syndicated markets took root after, in part because of investor demand for floating rate senior debt. That market is now a similar size to high yield. And then the CLO market, which buys loans and securitizes them, has taken off in size. So I think the market has just become so broad, and what we're seeing is the symbiotic coexistence between these different areas of credit, as there's just a broader continuum of financing solutions available for borrowers.
Yeah, it's very clear that at this point, borrowers have a lot of choices. They could go down the private credit context and get a negotiated loan with a bilateral counterparty. They could go down a syndicated context with the broadly syndicated loan, where that position is put away in dozens, if not hundreds, of potential CLOs or other types of owners. So investors have the opportunity at this point to have both public and private credit in individual or in collective portfolios or multiple portfolios that are well diversified. And you didn't really have that opportunity in broadly syndicated loans or high yield bonds 30 years ago. You didn't have that opportunity in direct lending maybe 10 or 15 years ago. But today, we've seen a pretty meaningful expansion across the board and the opportunity to develop diversified portfolios. Let's switch gears a little bit to the borrower decisions, or in the case of private equity sponsors buying companies, what influences their decision to go on the public side and the private side? Raghav, walk us through how a sponsor or a borrower thinks about the options there.
Sure. So you're absolutely right, Armen, especially for the larger borrowers and the larger sponsors. So think companies that need a financing of $1 billion or more. Those sponsors definitely see the markets, the public market and the private market as complementary, and they will more likely than not go into both markets, and they'll pick the market that gives them what they need for that specific financing. So as an example, if they care about speed and certainty of execution, or if it's a more complex credit than average, or if they need some flexibility like a delayed draw term loan, they will more likely go to the private credit market. If they care about a cost of financing, they will more likely go to the broadly syndicated loan market. The one trend that we're seeing, which is kind of interesting and somewhat new, is that we're now seeing single name borrowers go from the BSL market or the broadly syndicated market to the private credit market and vice versa. And this is happening now more frequently. So in the first half of 2025 alone, $28 billion of paper has migrated from the BSL market to the private credit market and vice versa. The other trend we're seeing, and again, I expect this trend to continue, is hybrid capital structures. So historically, a borrower would go to either the broadly syndicated loan market and fill up their financing needs only from that market, or go to the private credit market and do the same. Now you're seeing hybrid structures where you could have, as an example, a broadly syndicated first lien held by CLOs and a privately placed second lien. Or you could have a bank-held term loan A with a private credit term loan B. So you're starting to see the market converge around these options and then mix and match these options more and more. So if a manager has the ability to traffic in both the liquid and private credit markets, as you can imagine, they just have a much wider funnel of deals and hopefully quality deals to pick from.
It seems like a private equity firm or a borrower that is a repeat user of the markets would have the benefit of having a highly functioning public market and a highly functioning private market to be able to have options as their opportunity sets change. I remember during the pandemic period, there was a period of time there that the public market really seized up because I think the CLO buyers were not really buying. There was a general concern in that market, which resulted in eventually some loans that were committed to by banks were hung for a period of time. Meanwhile, the private credit market that has a different investor base, a different technical, was able to come in and provide an option or a solution to those same private equity firms doing deals. If you're a private equity firm, you really want to have options for both. And on that point, Danielle, can you talk us through, as businesses may change, swapping back and forth between broadly syndicated and private? I mean, Raghav mentioned, but what are your views on that kind of migration?
Well, I think that's exactly right. When issuance in public markets slows, that's an opportunity for private credit lending to pick up. And you highlighted the COVID period when banks were hung with a significant amount of deals on their balance sheets, and private credit lenders stepped in some cases to save the day. We also saw, as macro volatility picked up related to rates in 2022 and 2023, a number of deals get refinanced into the private markets from the syndicated markets. Now, as pricing is normalized, last year we saw that trend reverse. And so syndicated markets refinanced a lot of that paper at lower rates. And then today, as Raghav mentioned, we're right at around parity, which I think really speaks to the trend of convergence that we're talking about today. But I do think having those two markets is going to lead to an overall healthier market and a variety of ways for companies to get financing, even in more challenging economic backdrops.
Great. Maybe switching gears a little bit, I want to talk about the market opportunity. Can we actually deploy this capital that people are interested in investing with managers in the credit space? Is there enough going on?
Sure. It's actually quite interesting and timely. A strategy consultant recently came out with an estimate that to fund all the AI-related data centers that have been planned, $7 trillion will be needed globally through 2030. $4 trillion on computing hardware, but that still leaves trillions for real estate development, power infrastructure, and the picks and shovels. I think data center is obviously the CapEx story of this decade, but I think it also highlights an interesting transformation that I think the Western economies are going through, which is if you look back at the previous decade, A lot of the growth in GDP was driven by quote unquote asset light sectors such as financials, technology, and healthcare. For the next decade, I suspect we'll see growth in GDP driven by CapEx heavy sectors. AI data centers is obviously a big one, but you have an increase in defense, you have reshoring, you have the energy transition, you have all the fiber and telecom CapEx that's being laid out right now. So combined, it's trillions of dollars of CapEx that's required that will need to be financed. It will be financed by commercial banks, it will be financed by money center banks, it will be financed by the liquid credit markets and by private credit. And by the way, this will be across both investment grade and sub-investment grade. So I think there's just a ton of CapEx needs over the next decade where private credit will take its normal market share and provide that financing.
There's a lot of thematic areas of investing that are going to require private credit or just credit generally. In addition to that, there's a lot of sponsor-to-sponsor trading activity that occurs. Sponsors selling their assets to other sponsors, and they need private credit or broadly syndicated loans to help finance those transactions as just in the normal course. Daniel, what are you seeing in Europe and just in the broadly syndicated markets, the public markets generally? I mean, thematically, obviously, some of that I would say plays through, but what's your sense of that overall market opportunity?
Yeah, I mean, thematically, we're seeing the same things because I think if you think about big picture, 10,000 PE-owned companies, 90% of companies are private. They need financing solutions. AI, tech, that's driving it. A lot of the private credit issuance has been in tech and healthcare, about 40% of the issuance so far this year. But that still leaves this huge other amount across various different industries. You mentioned Europe. That's been interesting, especially in the liquid credit markets where you can pick up a little bit more yield. It's a smaller, less efficient market today. And there's also some secular trends there with certain countries increasing their defense spending, infrastructure spending.
You know, it seems like some private equity firms and just investors generally globally are trying to balance out their exposures a little bit between the US, Europe, and potentially other regions. I know, Raghav, we're seeing on the direct lending side some uptick in some of the European investing that some private equity firms are doing on the marginal dollar, looking to where they can, either the UK or continental Europe for opportunities. And I think maybe the basis is that those economies have been not invested in or underinvested in, mainly because of the war in Ukraine and some other country-to-country legal regime separations. But today, that's caused, I think, an opportunity to invest at reasonable valuations and with reasonable capital structures. So I know as a global investment manager, we're always interested in relative value between US, Europe, emerging markets, and other kind of developed economies. So it's good to see expansion outside of the US as well. And I think we'll have further opportunities to invest globally in some of these thematic areas, but also in private equity-backed companies. Let's talk a little bit about structure. What's happening in the private credit markets, and how would you compare that over time with the public markets? Are we sort of converging, or is private credit still meaningfully different, either in terms of pricing, legal structure, leverage levels, on any dimensions you think, Raghav?
Sure. I think first you have to break down the private credit market by size. And typically, and this is fairly common, most practitioners would divide the market into the lower middle market, which is usually 25 million of EBITDA or lower, the core middle market, which could be, depending on one's definition, somewhere between 25 and 75 million EBITDA, and then what's known as a large cap, which starts at 100 million of EBITDA, but really you're looking at financing needs of $1 billion or more. So really, if you assume 5 turns of leverage, 200 million of EBITDA or higher. And the reason you need to break down the market that way is it's only the upper end of that market, that the businesses that are looking for $1 billion of financing or more, that can access both the liquid market and the private credit market. So naturally, you would then expect that it is that part of the market where we are starting to see convergence in terms of credit agreements, pricing, and leverage between the public market and the private market. The private market, even for those really big borrowers, will still give you better LME, what's known as liability management protections. But away from that, LTVs, leverage, and pricing are starting to converge.
So you mentioned private credit transactions of $1 billion. Those borrowers having options in the public market versus the private market. In the private market context, is that a single lender providing that $1 billion or more of leverage? Is it a consortium of lenders?
Right. So that's actually a pretty interesting dynamic, because if you go back even 5 years ago, even for large deals, you could find what's known as two-handed deals, where 2 lenders speak for the entire deal. In the smaller deals, the middle market deals, you may even find single lender deals. So what's happened now is that the private credit market, even for really large deals, looks and feels a little bit more syndicated than it did 5-10 years ago. Even though there are some very large lenders that can speak for $500 million to $1 billion per deal, private equity sponsors have just realized that they do not want to take lender risk, if you will. And so they will naturally create a deal where there are 4, sometimes as many as 10 lenders in a deal, which is starting to feel a little bit more like the syndicated loan market where you have multiple CLOs.
So for the bigger deals, maybe gone are the days of the two-handed deal. Are you seeing or hearing of trading or the interest of trading in these private assets? Because as we think about the corollaries with broadly syndicated loan markets, and obviously there's a lot of trading, and that impacts outcomes actually in the broadly syndicated loan market. Are you seeing that kind of trading activity starting to pick up or not?
We are a little bit, this is known as secondaries. So you do see secondary trading of mostly portfolios of loans as opposed to single loans. So that aspect is still different from the BSL market or the high yield market where most of trading is single name loans or bonds. So one, you're seeing these trades happen on a portfolio basis. And second, usually the ones that go up for sale are more of the stressed portfolios as opposed to the pristine portfolios that are performing well. Now, if you have another dislocation like a COVID, where lenders are seeing redemptions and have to dispose of the pristine portions of their portfolios, I do think you'll see this step change up in more portfolio trades, even for performing loans.
Yeah, I mean, on this topic of convergence between public and private, it just seems like this particular point in some ways makes that convergence look a little bit faster, possibly. So it is something that we're watching in terms of trading activity in private loans, the interest of investment managers to create trading platforms in these areas.
So we're obviously seeing convergence in structure and pricing between the two markets. We're also seeing convergence in the buyer base. And this is interesting because high yield bonds, senior loans, these used to be institutional asset classes. They're now well owned by everyday investors in mutual funds and other types of portfolios. And you're seeing that adoption with private credit too. It's moving from more of an institutional market to the wealth market. It's being incorporated in different types of hybrid vehicles, evergreen vehicles, BDCs, interval funds, tender offer funds. As that buyer base shifts, I think you'll just continue to see the two markets become more of one and coexist as a single asset class.
So as the buyer base becomes uniform across all of these public and private asset classes, credit and otherwise, how do you think about portfolios? How do you think about portfolio construction? It used to be the case, or maybe it still is the case, that investors say, this is my private credit allocation, this is my public credit allocation. Are we seeing a little bit of convergence in that thinking? Are we now talking about credit rather than public credit versus private credit?
I think that's right. I think instead of thinking about it as two different asset classes, allocators are thinking more about outcomes. What do they want to achieve from credit? Is it income? Is it inflation protection? And they're structuring portfolios that way. When you can combine public and private credit in a portfolio, I think it optimizes your portfolio construction. You can really pick that right mix of yield and liquidity. We talked about private credit giving enhanced yield because of the illiquidity and the less frequent marks. That can be great in a certain market environment. But if markets are dislocating, how great to be able to go into public markets where you can buy things at a discount and quickly, and also have some dry powder in a portfolio to then fund those private deals, because that's a great time to step in as a private lender. We use liquid credit as a funding mechanism too for private credit, so we don't have cash drag in our portfolios.
Yeah, so we could be more selective as we pick the private positions that we want in such a portfolio. We could camp out in public credit and earn a nice income as we wait, and nice sort of risk protected or risk adjusted returns that pay us to wait, and we don't have cash drag. That's a good point, Danielle.
Armen, the other tactical reason for combining liquid and private credit in a single portfolio and thinking about portfolio construction across the two is that, one, private credit usually will throw off more current income at the expense of not having much original issue discount. In a market dislocation, if you combine discounted securities, whether it's discounted high yield and discounted BSLs, which naturally have a lower current income, with the high current income from private credit, you create a very interesting portfolio where you're still buying down your basis quite quickly because of all the coupon that's being thrown off on a blended basis, but you also have a pull to par opportunity. Meanwhile, because of the discounted purchases, you've lowered the overall cost of the portfolio. The other nice thing about adding private credit to a public portfolio is, as we all know, private credit marks based on fundamentals, not on psychology, which can infect the liquid credit markets more so than the private credit market. So when you add private credit to a portfolio which has liquid and private, the private portion acts as a volatility dampener. So you just get a much more smooth experience, which is more reflective of the underlying fundamentals of the borrowers and the economy, as opposed to just pure psychology.
Yeah. So I guess to say what you said, but in my words, so the private portfolio gives you stability and income, and the public portfolio, to the extent you could add it to it, helps to manage liquidity and helps to actually get opportunistic when there's a technical dislocation in that market for you to buy assets at a discount. So we talked a lot about private credit, and specifically when we were talking about private credit, we were talking mainly about corporate direct lending, sponsored direct lending. In the case of public credit, we were talking about broadly syndicated loans and high yield bonds. I think those are pretty well understood, and we're definitely seeing that convergence. But what else is out there in terms of other asset classes, either in the public land, in the credit space, or on the private side, that you think are attractive or will be interesting as we look forward in the next couple of years?
Sure. So I mentioned this briefly, but I do think asset-backed finance is very interesting. If you believe, as I do, that we are entering a period of high capex across data centers, defense, aerospace, what have you, then I think asset-backed finance is naturally an area that's going to grow and benefit by financing a lot of that capex spend. I also think adding asset-backed financing to a broader portfolio of largely direct lending, other types of corporate credit is an interesting diversifier, because asset-backed financing, you're not lending to a single corporate. So you're diversifying away from just pure corporate risk. And there are certain parts of that market which are not covered by insurers or banks, which are below the IG. They're below IG rated, where there is a complexity premium that you can also earn, in addition to adding a source of diversification in larger portfolios. The other more thematic thing we're seeing is sectoral niches. So there are certain smaller parts of the private credit market, such as life sciences and infra debt, where there is a above average complexity, where you need a lot of subject matter expertise. You cannot be a generalist and cover these markets, nor can you frankly originate by being a generalist in these markets. And because of that tougher origination, the tougher underwriting, as well as the structuring, you get a yield premium. So again, if you add those to a broadly diversified private credit portfolio, you again get the benefit of more diversification in sectors which are sometimes not very correlated to the broader economy.
What about in the public areas or areas that might touch some of these public markets? Danielle, what are you seeing?
Yeah, when I think about the global credit markets and Oaktree's opportunity set as we're constructing multi-asset portfolios, the core is usually high yield bonds and senior loans. And then the alpha strategies that add some spice to the portfolio are structured credit, emerging market debt, and convertibles. I think the opportunity in structured credit is very attractive today on both the corporate side in the form of CLO debt and equity, as well as in real estate, and in particular in residential mortgage-backed securities. CLOs are somewhat mainstream, but a lot of investors aren't utilizing them in the way that we are in a multi-asset context. So oftentimes the largest tranche of a CLO, AAA, is what many will buy. Our focus has tended to be in the double B. It's an unloved sub-investment grade rated part of the securitization, where you can get on average 500 basis points of excess spread compared to similarly rated debt. So it's an area we've been allocating to. It doesn't come without its risks in the terms of mark-to-market volatility. And so it pairs really nicely in a multi-asset portfolio. On the real estate side, the residential side is interesting given the rate backdrop in the US. Not a lot of people have been going out to buy new homes or refinance their homes at the prevailing 6-7% mortgages for a fixed 30-year mortgage. And what that's done is it's provided some disruption in the RMBS market. These are instruments that we can buy at a discount to par. Should rates fall and refinancing pick back up, we can actually out-earn our stated yield. So there's a little bit of a technical in that market. And just generally, I like the backdrop of housing compared to the financial crisis. We have undersupply. We have much higher borrower FICO ratings. So that's an interesting part of the market that we're mining opportunities. And then you add in some convertible bonds, emerging market debt. This really gives you diversification in your liquid allocation. And then, of course, adding in private credit can only enhance that.
Okay, great. Really distilling what both of you just said, it seems like although there's this very well understood core in the private side of corporate direct lending on a first lien basis to private equity sponsors, and on the public side, high yield bonds and broadly syndicated loans, that seems like the core of the private credit market and the public credit market. But if I was to think about what you said in addition was, to really tap the best of the private credit market and the public credit market, you need to have skills beyond just that core. In the case of public markets, Danielle, you talked about CLO tranches and RMBS and having specialists and experts in those particular areas to be able to assess the relative value benefits, whether it's in risk or return or both, as those markets move. And that's a huge differentiator, I think, for a credit strategy or a credit platform. And on the private side, Raghav, you mentioned life sciences and asset-backed finance and opportunistic credit as other private credit areas that can provide additional return and diversification. I think that is a very important point in both, because you often do want to have uncorrelated investments so that if there is a shock to the economy or a shock to the markets, that you're not having all correlations going to one. In the case of life sciences, you're right. Those businesses are really not derivative of GDP. In the case of asset-backed finance, in terms of diversification, I think it exposes or offers investments in industries that you often don't find in corporate direct lending. I think of these pools of assets in aircraft or rail cars or student loans or credit cards. You don't really see a borrower that gives you that exposure. And as a result, globally, the total market opportunity in asset-backed finance is in the many, many trillions of dollars. In the case of asset-backed finance, you're not attaching at the net bottom line cash flow. You're attaching at a critical cost line for a borrower. So let's take, for example, an aircraft leasing company or an aircraft company, an airline. They have revenues, they have costs, and one of those costs are leasing airplanes. And that lease is what forms the basis for an asset-backed finance deal. As long as that company is in business and wanting to fly a diversified pool of such aircraft, then they will pay that lease. And you could say the same about rental payments, royalty payments on medical royalty, or life sciences royalties, or music. It just is so far reaching and a very attractive diversifier in an overall credit allocation. I think next steps, would love to hear what you think we're going to see in the private context, the public context going forward. Is the convergence going to go the other direction? Is there going to be more opportunities or less?
Yeah, I think the conversion is going to increase. And we talked about liquid versus private. Armen, you also mentioned non-corporate lending, such as asset-backed financing. And if you look at the market in terms of what private equity sponsors want, what investment banks want, what management teams want, they want lenders that can offer the entire breadth of capabilities across liquid versus private, corporate versus asset-backed financing, US versus rest of the world, and then also performing versus more opportunistic. And I think the managers who have the greatest right to win will be the ones that can bring all of these capabilities to bear to the market, because the market prefers one-stop solutions as opposed to having to go to dozens of different lenders for a dozen different needs.
For me, diversification is the key. When you're combining these asset classes and you're going outside of core markets, you're adding diversification and uncorrelated asset streams to your portfolio. When I think about how we at Oaktree can add value to our investors' portfolios, specifically in the multi-strategy space, in order of importance, one, it's exposing them to things they may not otherwise invest in that have higher potential. Two, it's going into those markets and through our bottom-up fundamental research, doing better than the markets, avoiding the losers, letting the winners take care of themselves because we are credit investors. And then three, it's an opportunity for asset allocation and thinking about relative value when markets dislocate and shifting capital between core strategies and some of our alpha strategies. And I think that really opportunistic piece is core to Oaktree's DNA. It's shown in how we approach our borrower community and the flexibility of solutions we can offer them, as well as how we flexibly design portfolios for different market environments. So dare I say, maybe the markets are converged, and that plays to Oaktree's strengths as being able to offer this in both ways.
So maybe if I could just wrap up, it seems like there's a growing level of convergence between public and private, a growing opportunity set in some of these other areas that are new and esoteric and offer diversification, additional return, some complexity. I think that this range of opportunities is great for investors. It's also great for borrowers. Borrowers now can tap so many different ways with the markets or with particular managers, and for them to offer asset-backed solutions or corporate credit solutions or public credit solutions to that same set of borrowers or private equity firms or intermediaries or counterparties. And I know that at Oaktree, we value very much our ability to work on many levels with the same counterparties as they are repeat market participants and are excited about what the future will hold.
Notes and disclaimers. This recording and the information contained herein are for educational and informational purposes only, and do not constitute and should not be construed as an offer to sell or a solicitation of an offer to buy any securities or related financial instruments. Responses to any inquiry that may involve the rendering of personalized investment advice or affecting or attempting to affect transactions in securities will not be made absent compliance with applicable laws or regulations, including broker-dealer, investment advisor, or applicable agent or representative registration requirements, or applicable exemptions or exclusions therefrom. This recording, including the information contained herein, may not be copied, reproduced, republished, posted, transmitted, distributed, disseminated, or disclosed in whole or in part to any other person in any way without the prior written consent of Oaktree Capital Management LP, together with its affiliates, Oaktree. By accepting this document, you agree that you will comply with these restrictions and acknowledge that your compliance is a material inducement to Oaktree providing this document to you. This recording contains information and views as of the date indicated, and such information and views are subject to change without notice. Oaktree has no duty or obligation to update the information contained herein. Further, Oaktree makes no representation, and it should not be assumed, that past investment performance is an indication of future results. Moreover, wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. Oaktree believes that such information is accurate and that the sources from which it has been obtained are reliable. However, it cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. Moreover, independent third-party sources cited in these materials are not making any representations or warranties regarding any information attributed to them and shall have no liability in connection with the use of such information in these materials. Copyright 2025 Oaktree Capital Management, LP.
Audiation.